Hello, everybody. This is Alan Elman, the Blue Collar Investor, and welcome to this video titled The 5 Most Common Mistakes Made by Covered Call Writers. Over the years, I've had the good fortune to be in touch with literally thousands of covered call writers from all over the world. My team tells me that we have members in 80 countries outside of the United States. One thing I've noticed that there seems to be a common group of errors made by beginning covered call writers. I felt that it would be of educational value to all of you for me to share with you what the 5 most common mistakes that I see made by covered call writers from all over the world. So let's get started. Number one, starting without adequate education. I've noticed when I do my webinars, my live seminars, when I have my emailings with members from BCI, I've noticed that they get very excited when they start learning about these low risk option selling strategies. And the same applies to selling cash secured puts. And they want to get started right away. If I do my seminar on Saturday, they want to get started on Monday. But that's not really feasible. It takes time to master what I call the 3 required skill sets necessary to achieve the highest levels of returns. And for most beginners, it will take about 3 to 4 months of due diligence to get to the point where you're ready to get started. So what are those 3 required skill sets? Well, you could see them in these bullet points I have on the screenshot. Number 1, stock selection. What underlying security are we going to use? Could also be an exchange traded fund. Now, once we have our watch list of eligible stocks or ETFs, then what option are we going to sell? What expiration date are we going to use? What is the moneyness of the option? Out of the money, at the money, in the money? We have to understand the benefits and disadvantages of each of those. And finally, once we enter our trade, how do we manage them? What exit strategy opportunities might come up that will help us increase our returns to even higher levels? So those are the 3 required skill sets. Now, mastering 1 or 2 of them is not good enough. No, we've got to master all 3 before we risk even 1 penny of our hard-earned money. Now, this is extremely important. That's why I have it at number 1. And we'll discuss a little bit more about that at the end of this video when I briefly go through some of the BCI resources that will give you the education to master the strategy of covered call writing. The second of the most common mistakes made by covered call writers is selecting high implied volatility stocks. Now, why is this a mistake? Well, extremely high implied volatility stocks return very juicy option premium returns. So retail investors, when they're starting out, can get enticed by these premium returns. Wow, look at what I can get for stock ABC. I'm doing it. Well, the problem is that these high implied volatility stocks also come along with greater risk to the downside. We could make a lot more money, but we could lose a lot more money. And that may not align with our personal risk tolerance. Now, the implied volatility is inherent in the premiums that we get. So if we know our personal risk tolerance, we will then know the amount of returns that aligns with that personal risk tolerance. For me, when I'm doing monthly options, it's 2 to 4%. The implied volatility of the underlying security is inherent in those returns. So we don't actually have to look up the implied volatility, although we do provide that information to our premium members in our premium member reports. Now, my mom's portfolio, I do 1 to 2%, a little more conservative. What's right for you? Only you can determine that. You may or may not align with what I do. Now, if I was doing weeklies, it would be 1/4 of the 2 to 4%. So that is an important point. Now, let me hammer that home in the next slide, which is a risk reward profile. So all the way to the left of this screenshot is no or low risk. And all the way to the right of the screenshot is high risk, high reward. Let's start on the left side of the screenshot. So what would be an example of no or low risk investing? Things like treasuries, money markets, CDs, those are basically no risk with low returns. Now, moving a little bit to the right of that, that's where I place covered call writing, as well as selling cash secured puts, riskier than treasuries, but nowhere near what I'm about to show you on the higher end of the risk reward spectrum. Now, a little bit to the right of covered call writing and selling cash secured puts is buying and selling stocks. So why do I have buying and selling stocks as riskier than covered call writing? Well, the reason is that our break-even price points are lower when we do covered call writing. Let me set up an example for you. Let's say we buy a stock at $48. What's our break-even price point? It's $48, right? If it goes higher, then we have a profit. If it goes lower, we have a loss. But let's say we buy a stock at $48 and then sell the $50 covered call for $1.50. What's our break-even price point then? It's the 48 we paid for the stock minus the $1.50 we generated from selling the option. Our break-even price point is 46.50 over here, where it would be 48 over here. And that is the reason why when we sell covered calls or cash secured puts, we are putting ourselves in position to beat the market on a consistent basis and many years substantially. Okay, let's move over a little further to the right of the risk reward profile where we can make a little more money, but also create greater risk to the downside. Those would be things like trading naked options as opposed to covered call options, shorting stocks, or casinos. You know, casinos are set up for the casino to make money, not for us to make money. So that would be situations where we could make a lot more money, but we could also lose a lot more money. So we have riskier scenarios as we move further and further to the right of the risk reward spectrum. Now, if we were going to take this all the way out to the end of the risk reward spectrum, huge risk, huge reward, lottery tickets. You know, we could get generational money if we win the lottery, but, you know, we're probably not going to win the lottery. And more than likely, we're taking our money and throwing it down the incinerator. So there you have it. You can go from treasuries to lottery tickets. When you're doing covered call writing and cash secured puts, you're much, much closer to treasuries than you are to lottery tickets. So understand that when we set up our trades for covered call writing, if we start using high implied volatility securities, we're moving the spectrum a little bit further over to the right by using the high implied volatility securities. Number 3 of the most common mistakes made by covered call writers is not considering earnings reports. Now, I know a lot of you have seen strategies where you do covered call writings inclusive of earnings reports. I'm completely against that school of thought, 100% against that school of thought. And here's why. As I stated previously, covered call writing is a conservative, low-risk option selling strategy. It appeals to certain investors like me and possibly like you as well. For those of us looking to hit grand slam home runs, make a lot of money quickly, covered call writing is not a good strategy for you to consider. But if you're looking to hit singles and doubles all day long, then these strategies may in fact be appropriate for you. By incorporating earnings reports into the strategy, we are creating a much, much higher risk scenario because, as many of you know, a disappointing earnings report can impact the share price in a big, big way. Could also enhance the price of the stock. When we do covered calls, we're capping the upside, aren't we? So I say, and emphatically so, in my humble opinion, never, ever write a covered call if there's an upcoming earnings report. Take it out of the equation. Why take the risk? Now, we know the date of the earnings report. we know it's a risky event, we can easily take it off the table. Number 4 of the most common mistakes made by covered call writers is not factoring in diversification. If we have 5 securities in our portfolio and 4 of them are computer hardware stocks, and that particular industry segment tanks in the current contract cycle, our portfolio is hurting big time, isn't it? But if we have 5 different industry segments in our portfolio and one of them tanks, we have the other 4 to pull us up and to help mitigate losses. I think that's common sense to most of us, but sometimes we kind of miss the obvious. So I had to include this in my list of the top 5, which we're heading to right now. Number 5 is not factoring in cash allocation, which is just as important as diversification, right? I mean, if we have a stock that we have, let's say, $40,000 invested in our portfolio, and all the rest have maybe 2,000. If that $40,000 we have invested in a particular security goes down, maybe bad news comes out about it, well, our entire portfolio is going to be hurting big time. Whereas if it was just equal with all of our positions from a cash perspective, well, then we have the other positions, just like with diversification, to help mitigate and to pull us back up. So when we're factoring in and calculating cash, as you'll see in the next spreadsheet, it won't ever be precise. Like if we have 100,000 in 5 positions, it'll never come out to every position is 20,000. But we're going to be in the ballpark. Okay, we're going to be in the same galaxy. And that will be a smart way of crafting our portfolios from the perspective of cash allocation. Now, the blue collar investor has developed 2 spreadsheets we call the BCI Portfolio Setup and Results spreadsheet. What you're looking at now in this screenshot is the portfolio setup spreadsheet, which will incorporate into it both diversification and cash allocation. So in this particular example, at the time, the portfolio had in it $102,217. The spreadsheet calculated that each position were allocating $20,443. Now, when we enter the price per share, the spreadsheet will tell us how many shares we could buy, and will then round it off to the nearest 100. There is also a section of the spreadsheet not shown in this screenshot where you could change it if it turns out we've spent too much money, not enough money, or we don't have enough cash available for potential exit strategy opportunities. So here in this particular screenshot, you could see that all the way to the left, we have 5 different industry segments over here. All the way to the left in those blue cells, it will let us know how many shares of each we're going to buy. We've entered in the price per share, and how many contracts we're going to sell, and then the amount that we're spending on each position. Now, they're not precise. They run from 17 to 25, but at least, let me go back now, the screenshot here. It turns out that we've spent 99,623, and that leaves us a balance of 25,94 for potential exit strategy opportunities. This is what I consider to be a solid initial portfolio setup in terms of both diversification, as you could see all the way to the left over here, and cash allocation, as you see all the way to the right over here. And we do have our cash reserve in case we have any exit strategy opportunities that come up in that particular contract cycle. And although there are some contracts where we don't need any exit strategies, more likely than not, there will be at least a few. And it's good to have that cash on the sideline so we could take advantage of them. Now, just to summarize before we get back to the education aspect of it, avoiding any one of these 5 most common mistakes will put cash in our pockets. But can you imagine over a lifetime investing, what it will mean for us if we can avoid all five of them. It will have a huge financial impact on the quality of our lives as we move into or continue our retirement. And that's the reason why I made this video. Now, let me just go back to the education and the BCI resources. And I'm going to only spend a couple of minutes on this because on the website, we have videos that will give you more details. So if you go to our website, thebluecollarinvestor.com, to the right of the membership link is our store. And when you click on that, you can go to Best Packages or Build Your Own Toolkit. I'm going to suggest you go to Best Packages where you can get the best discounted educational products. There are three best discounted packages. The main one is the BCI package, which is an acronym for our best and most comprehensive investment package. It contains 6 online video courses with downloadable workbooks, about 2 hours each, 6 calculator spreadsheets invented by the blue-collar investor, found nowhere else, and 5 of our best-selling books in ebook format. And best of all, our 13-month annual premium membership, which will give you 4 reports of eligible option-selling candidates, along with over 250 training videos and dozens of files and downloads. The second of our best discounted packages is our Trade Management TMC package. It includes a spreadsheet, which I'll show you in the next screenshot, which is a must. If you're using covered call writing or selling cash secured puts, you must have this spreadsheet. The TMC package includes that spreadsheet along with its 28-page user guide and the PDF version of my 8th book, Exit Strategies for Covered Call Writing and Selling Cash Secured Puts, 27 chapters of exit strategy information. Here's a screenshot of an overview of the trade management calculator. I'll just stick to the top part, covered call writing. The lower part is cash secured puts, but they're similar. And all the way to the left, you can enter your trades into these blue cells and then get your initial calculations in these white cells per trade and per portfolio. In the middle section, you can make your exit strategy adjustments, and the calculator has over 20 different exit strategies inherent in the spreadsheet, and they get your final post-adjusted results per trade and per portfolio. You also have a segment all the way to the right where you can make notations into the trade journal. There is no other spreadsheet like this anywhere in the world, and that's part of our TMC package. Now, you'll also be able to combine BCI with TMC when you go into the best discounted packages section. The third of our best discounted packages is our CEO package, which is an acronym for combining exchange-traded funds with stock options. It's a streamlined approach to covered call writing. And it includes the spreadsheet that I showed you before, where you can set up your portfolio. And it also includes a portfolio results spreadsheet. And it has about 40 different rows where you can enter multiple trades for that particular portfolio. It also includes PDF version of my 9th book, Covered Call Writing, A Streamlined Approach. It's really great for those of you that are working multiple jobs, raising children, maybe in retirement, you have a lot of hobbies you want to dedicate a lot of your time to. So if time is limited, this is a great approach to covered call writing. Now, as part of the CEO package, you have an opportunity to combine it with TMC or to combine it with both TMC and BCI and get our CEO total package. If you have none of our resources, this is the best discounted package we offer. Now, if you already have a lot of BCI products and you just kind of want to fill in, when you go to the store, go to Build Your Own Toolkit, and you can pick and choose from all of the different resources we offer. So, ladies and gentlemen, that ends this video, the 5 most common mistakes made by covered call writers. I really felt that it was important to make this video because I'm sharing with you feedback that I've received from thousands and thousands of options traders all over the world. And by learning from each other, we all become much better investors, achieving much higher returns. And that is what I wish for you. Thanks for listening. And as always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.